Well, America's farmers are expected to bear the brunt of retaliatory tariffs, with the majority expecting new trade policy will negatively impact their farms' income in the year ahead. That's according to a survey from Purdue. Now, the American Farm Bureau Federation estimating nearly $27 billion worth of U.S. goods will be targeted by retaliatory measures, with significant impacts on soybeans and cotton specifically. Joining us now with more, Michael Langemeier. He's the director of Purdue University's Center for Commercial Agriculture. Thank you so much for being here, Michael. Just to get a sense, can you kind of operationalize for me, how do tariffs impact farmers and how do they specifically impact their income?
Okay, let me talk a little bit about the Producer Sentiment Index, and then I'll get into the question you have. The Producer Sentiment Index is derived from a monthly survey that takes place mid-month. In October, the index was 115. In November, the index jumped to 145, partially as a result of the election. We reached a peak at 152, and now it's dropped off to 140 using the survey results from mid-March. And so that's where we're at. We did see some reduction here from February to March, and that's primarily due to policy uncertainty, specifically related to tariffs. You asked the question about the negative impact. The 55% think there's going to be a negative impact on their farm income because of the tariffs. That really takes the form of reduced prices and higher costs, and so it really affects both of those. Certainly when you have goods like soybeans and wheat that are heavily dependent on tariffs, it's probably going to see a reduction in exports of those commodities, and so it's going to have a negative impact on the price. And then also there are also items that we import to produce crops and livestock, and those input costs are going to increase as a result of the tariffs. And so as a result, you see a margin squeeze coming from both reduced prices and higher input costs.
And I know in the survey data, farmers are indicating that they're anticipating some sort of rebate or kind of sweetener that allows them to stomach the pain of tariffs. What if that doesn't come to fruition? What is that impact potentially going to be?
If that doesn't come to fruition, 2025 is going to be a very rough year for net farm income, particularly for crop producers. Livestock producers, specifically beef producers, have pretty good domestic market right now, and so the prices are pretty strong in a lot of livestock commodities, but that's not true with corn, soybeans, and wheat and cotton. And so if we don't get some payments related to the tariffs, and the tariffs actually do take place and stay in place for a while, you're going to see a rather large negative impact on net farm income for crop producers.
Now, Michael, you just mentioned that the survey is conducted mid-month, but here we are, at the end of the month, at the start of the new month, and today we will find out, more about tariffs. So I guess my question is that $27 billion that you mentioned, is there upside to that number that we should be thinking about?
It's really uncertain right now, and so it's very difficult to come up with those estimates. And it really depends on how big the tariffs are and how widespread those tariffs are. Whether that 27 billion will be should be larger or whether it should be smaller. So there's just a lot of uncertainties right now, and that's creating some angst, definitely some anxiety in production agriculture.
And Michael, stay with us, but I actually want to ask Chris a question really quickly, because Chris, Michael's making it very clear that there is an inflationary impact to tariffs. There's also an economic one when it comes to labor, the income for these farmers. The president was elected in part due to his promise that he was going to combat inflation. If we start to see so much inflation happening, what does that do not only for constituents who are hoping to see a lowered impact of inflation, but also to financial markets?
It probably says that the Fed is not going to deliver any rate cuts this year, if we see this inflation continue to step up, because we've already seen it, and we're already starting to see Fed officials like Bostic start to back down from the Fed's updated set of projections calling for 2 rate cuts, right? Bostic is now 1. My personal bet is that we won't have any idea until we get to the June policy meeting if we will get any cuts this year.
Right, and that's something that is antithetical to what we're seeing from the market now pricing in 3 rate cuts this year.
So it's predicated on the economy falling apart. Right. But so far, just look at today, right? We get the March ADP employment report, 155,000 jobs created, right? Both manufacturing and services side. more than double what we got in February.
Yeah.
So I don't see how Powell on Friday delivers any kind of, oh, maybe we'll see some rate cuts.
Maybe we'll see some rate cuts. Yeah, that is a key question for Powell on Friday. Michael, I want to bring you back into the conversation here. What do you think the single biggest message is from farmers to this administration about tariffs right now?
If we do have the tariffs, it's going to be necessary to have payments similar to what we saw in 2019 if you're not going to have a very negative impact on farm income. And getting to the inflation, the interest rate, we've done some survey questions related to what they expect to happen to the prime interest rate, what they expect to happen to inflation, and it was very noticeable here in the March survey that they expect inflation to increase, which is going to have upward pressure on input costs and agriculture, specifically, specific inputs, but also they're less convinced that we're going to have interest rate deductions, and so that's also not positive because agriculture is a very capital intensive business, and they were looking forward to some interest rate cuts.
So, Michael, to the extent that farmer income is under pressure as a result of what develops, there's a great relationship between farmer income and replacing equipment. So, from a company perspective, whether it's John Deere, AGCO, are there other companies out there that could be vulnerable?
Definitely, any company related to making capital investments. So equipment is certainly a large one there, but I think also agriculture banks. If income is a little bit tighter, it's going to be difficult for some people to repay term debt. Debt that they've incurred on land and machinery, and so I think also that industry is going to see a more financial stress than we would have seen otherwise.
All right, Michael, we got to leave it there. Thank you so much for joining us. Appreciate it.